Welcome back. President Trump meeting with fellow world leaders this week at the G20 summit in Hamburg, Germany. Global economic growth, trade, financial regulations, all on the table for talks. But what can investors expect from the global economy moving forward? And more importantly, how do you invest globally? Mark Mobius is with us this morning, and of course, he's largely invested in emerging markets. Mark, the emerging markets have been outperforming since the beginning of the year.
Yes.
To what do you attribute that? And do you think we're finally seeing a recovery in this part of the world, which has taken a long time?
It's taken a long time. You must remember the 3 years before the beginning of last year, 2016, we had underperformance because the U.S. market was so strong. Emerging markets, of course, were not doing badly, but in comparison to the U.S., they were really second class. Since the beginning of last year, then we're beginning to see outperformance. And I think the reason is that many people realize they were severely underweight in emerging markets. Emerging markets now represent 30% of the world global market capitalization, 40% of exports, 40% of imports, 40% of GDP. So, you know, if you're not in emerging markets, you're not really getting the growth, that's growth potential that you see in emerging markets. Growth is 4% average. And then you have China and India growing at 6–7%. So it just makes a lot of sense for people to be back in emerging markets,
yes,
which is what's happening now.
This is a really important point that you make, because I want to get your take on the U.S. We'll do that in the next block. But when you look at the growth numbers out of China, 6–7%.
It's incredible.
You can't compete with that when you look at the 1.4% that we had in the U.S. How do you invest in China? Is that the place? That's one of your large holdings. China, India, Korea, Brazil, to a lesser extent, Argentina. Tell us how you approach China.
What we do is invest in China through Hong Kong, because a lot of the big stocks in China are in Hong Kong. They're listed. However, now the Chinese are beginning to open up the A-share market, which was prohibited for foreigners for quite a long time. And that means we can get into the small and medium-sized companies, who are very exciting things happening in that territory. So I believe now China is going to become much more important going forward.
And so how much of a portfolio do you want to have in China, given that that's really the growth story?
Now it's about 28%. I don't want it to go too much higher, because we can't ignore places like India, that is growing at even greater rate than China. And of course, Brazil is coming through as a result of reforms. So, you know, you don't want to have too much in China, but at the same time, at least 20% or more.
Well, India, you also have the rule of law. It's different. It's not communist. I mean, you know, you've got other ideas in terms of the growth story in India, right? Exactly.
And the reforms in India that Modi is putting into place, particularly tax reform, has been having an incredible success, and it's really very exciting.
Let me ask you about the trade story. You know, you say that these emerging markets represent 30% of the overall market capitalization. Are you worried about a potential trade war? Are you worried that we see a reciprocal tax when it comes to China, when it comes to India and the U.S.? Because Harley-Davidson CEO was on with us a few weeks ago, and he said, yeah, China charges us a 100% tariff. India charges us a 90% tariff. And the president has been very clear. For those countries who charge that kind of a fee, we will do the same. Is that going to upset things in terms of trade?
I think the Chinese are going to be very, very cautious, and I think they will give in on a lot of these issues, because they realize an open trade system globally is very, very good for China. So they are going to probably give concessions to Trump. And I think it's good that Trump is going after these countries, because in many cases it's been quite unfair. Not only in the tariff, in the import tariffs, but also in the trade in terms of investment. You know, investment restrictions in these countries leave a lot to be desired. So this is something we have to look at.
Now, you mentioned China opening itself up to A-shares. Recently, Chinese A-shares were included in the Morgan Stanley Emerging Index.
That's right.
That was a big deal.
A very big deal. Of course, that's going to take place over quite a long period of time. It'll start next year, and then gradually they'll include those A-shares. In the meantime, China is going to be opening up the capital account so we can see, the problem is bringing money in and out. Bringing money in is one thing, but getting it out is another.
Right.
So if there are restrictions, we don't want to be too heavy in the A-shares.
No, you want to make sure you can get the money out.
Exactly.
You've got liquidity. How tough is it investing in Korea? I mean, you saw President Trump with the new president of South Korea, who said, look, I'll meet with the president of North Korea anytime as long as the conditions are favorable. I mean, do you worry that with the North having all of this aggression about investing in companies in the South?
It's worrying, but you must remember that the companies we're investing in Korea are global in nature, many of them. companies like Samsung are really not Korean companies alone. They're global. LG is global. You name, go a whole list. Even the small and medium-sized companies are very much oriented towards a global marketplace. So yes, of course, if there's a war, all bets are off. But I don't see that happening anytime soon.
And again, you want to invest in this part of the world because that's where the growth is.
Exactly.